So these are the three things that I'm watching closely. The 10-year Treasury yields, they obviously are remaining elevated. No matter what the Fed's doing, and there's a lot of discussion on the Fed, the 10-year is really, in my world, kind of what drives real estate investing. The second one are the tariffs and the inflation rates. Why is that important? Well, because I'm a builder too. We're building over 1,000 units. So we are impacted by all these kinds of things. And then, of course, what's happening with the various real estate classes. Now, when I talk about real estate classes, what I'm talking about is multifamily, single family, industrial, office, malls, self-storage, the whole gamut. So it's really important to understand that a lot of times when people talk about the real estate market, they want like a really specific answer. But really what they want is they want to know, I live in Orlando, Florida. What's going on in my market? That's what they really want to know. But the truth is that we are a national market and things are going on all over the place. So what's happening in Florida is very different than what's happening in California or Texas or Arizona or Nevada. And then you can even dig down even deeper. So like in Nevada, Reno is very different than Las Vegas. So Tucson is very different than Phoenix. And then even sides of Tucson and Phoenix. So it's important to understand that real estate is super regional and very specific to market to market to market. And that's why I like it, because it's incredibly inefficient. But what I'm going to show you guys today, how you should be looking at this particular market and how do we take advantage of all this stuff that's going on, whether you're on the blue team or the red team, it doesn't really matter. The fact is it's going to roll out no matter what we think. It's going to go the way it goes. And so from there, though, that's your playbook. Okay, so once again, when you guys look at this, the reason why I put this chart up is because I always say that what is it that you see? Everybody's trying to put this cycle into the box of 2007, 2008, 2009. It is not even close. And the reason I put both of these things in here is so you guys could kind of see where we were at the different time frames when things peaked and when they hit the trough. So obviously you've got the first phase one, which is the stabilization phase, and then it gets stable. And what happens is prices get pushed up, and that's when we get to the asset bubble itself. And then, of course, like always, it gets oversupplied, and then they move down into the stagnation phase. This is a very common cycle. So it's always interesting to me to try to figure out where we are in this cycle, because the last thing that you guys want to do is you do not want to buy when everybody's buying. That's the last thing. You want to buy when people aren't buying. You want to buy when the banks are in trouble. You want to buy when there's chaos. You want to buy when there's high expenses. You want to buy when there's high debt. You want to buy when there's cracks, because everybody can fog a mirror, raise some money and buy something and then hope that the appreciation gets them there. But what I do is I'm trying to buy things for 5, 10, 15 years and plus. I don't like to sell properties. I'm buying them for the cash flow. I'm buying them for the tax benefits. And I don't like to exit properties if I can avoid it. Because what's the whole point? The whole point is to utilize tax laws, which we'll get into. That's the whole point. The whole point is to have income coming in passively, mailbox money when you sleep. That's the whole point. And then you also get the tax benefits, because on a lot of our projects for years and years and years, we had income and we paid very little or no tax at all as a result of some of the depreciation things and those kinds of things. So that is the entire point of all this. And so when I first started, I started with a 2-bedroom, 2-bath that barely cash flowed. And then I bought another one, and then I ran out of money. And then I had to go find people with money, and I just kept going. And so here I am 30-some years later with thousands of investors at this point.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
There's a couple of reasons why 2007 and 2022 are very different. And the primary reason is just one thing. As we led up to 2007, I was in the rental business just like I am today. I was losing people out of my apartments as they were buying single families. And at this time, at the peak, there was about 1.7 million homes being built a year, households, a year. Okay, so what we had during this period of time, during that decade, there was about 12.8 million homes being built during that decade. Okay, now if you go back one decade before that, you're going to see a very, very different number. So what happened during that period of time is we oversupplied the market for the amount of people. That's it. Simply, that's it. Then the bubble popped, mostly on the single family side. And then all of a sudden, we had all this excess inventory because at the same time, builders were just building to try to accommodate what was then the demand. Well, then the demand changed. So now we have the supply problem in 2007, 2008, and the demand went down. So here's what happened. We were struggling like crazy in the rental markets because we were losing people, because you could literally, we were denying applications and they would go buy a house. Those people, the 69% home ownership went to 68, then it went to 67, then it went to 66, then it went 65, which is where it is today. So today we're at 65% home ownership and 35% rental. And I got a chart here that's going to show you which direction it's headed. The reason why that's important, because it doesn't matter which road you're on. If you're a home builder, probably not a good time. If you're a landlord and you own rental property, it is going to be a good time. Why? Because you have affordability problems today. We're going to go up to the top of the chart here. 2007, 2022, very different scenarios. 2007, you're oversupplied. We've just built 13, 14 million homes in the last decade, and 4 million homes go on to the MLS, or the multiple listing service. Today, fast forward, we just crossed over 1 million. We're not even close from a supply standpoint to where we were back then. Not even close. In 2007, we had excess inventory, rate cuts, and prices went down. So what happens when you flood a market with 4 million units onto the market? Prices come down. If you take a look at, this came out, this is a year old. If you look at affordability, it's going to be 6, 7, 8 million that we have a housing shortage. Now, why is that? It's because, going back to what I originally said, in 2007, when the things popped, and there's 4 million homes on the MLS, all of a sudden, the building retract, as you would. And so there's this lag period after 2007, 8, 9, 10, where there wasn't a lot of new construction. But guess what happened? People were born. Immigration happened. People moved out of school. All that stuff. What did it do? And then you have this shift of people, like I mentioned earlier, from the home ownership side to the rental side, putting pressure on rents. So we're very different than 2007, where we had 4 million of excess. Okay, so today, this is why prices are holding. Now, maybe they're not holding in Orlando. This is not what I'm talking about. I'm talking about nationally. So this is a really, really important factor. So let's don't forget about that. Here's the next slide. So this is the one I was telling you guys about. The red are the renter households year-over-year growth, and the blue are homeowner households. Now, it's not that difficult to tie this back to government policy. So what what the red that you see during that first period of the chart, what that really did, people were shifting, just like I was talking about, from home ownership to the rental side. So what was going on during this period of time? I was buying like crazy. 2009, 2010, 2011, 2012, all during this period of time. And what did I get to experience? 4, 5, 6, even 10% year-over-year rent growth. Now, this is also when a whole bunch of people got into the game. They started raising money. They started putting together funds. They started buying stuff, but the game was over. They just didn't know. And so we very selectively moved very, very slowly during this period of time because we had already gotten all that gain and we were still holding those assets. So those assets were worth a lot of money. And so during this period of time, what were we doing? Making sure they're rented really well, making sure they're running extremely well, trying to manage the expenses as best we can, trying to keep them occupied as we can, waiting for rates to be at a point where we could scoop the refinance proceeds and distribute it to our investors and hold the property. Because if I sell the property, I have capital gain, I have the depreciation recapture, I have to figure out what to do with the money again. I'm going to stick it in a bank account. It's making 1 or 2%. Inflation is higher than that. That's the last place I want my money. So this is all part of what we're looking at when we're trying to figure out what side of the fence do we want to be on from a real estate standpoint. So here we are today, and you can start to see these red spikes. So I believe that we're heading into another, what I would consider to be a renter nation. It's going to be very interesting to see how far this goes. And so what we have is we have this affordability issue where they can't necessarily buy a home today. The rates are what they are, and everybody's clamoring for these, quarter point, half a point. It's going to help a little, but it's not going to move the needle. What they really need is a lot of homes to hit the market. So they're either going to hit the market because people want to list and move. So rates would need to come down for that, or to build them, okay? And rates need to come down for that. In 2024, we had the highest apartment deliveries on record. Not necessarily great for a builder or a developer, but it's really good for a renter. And what does this do? This stabilizes rents. That's what new supply does. So you have the supply problem, and you can see it. It drops off significantly. So what do you do at this point? You do two things, which is exactly what I'm doing. One, you start to buy existing projects that are done and completed, and somebody else has taken all that construction risk. Another strategy is to try to clean up mistakes that people have made. That's another strategy. But one thing is for sure, we're 4.5 million short. We're heading on a supply decline, and the demand is coming because of affordability. So that's what I see. So this is vacancy rate, deliveries, and NOI, or net operating income. For those of you guys might not know, NOI is income minus expenses. And so you can see what happened during the net operating income is it peaked and then it went down. And so what we have here is a problem. And the problem is that now deliveries have peaked. And I just showed you in the prior chart, they're on their way down. And now you got your vacancy on the way up. So again, this is what you want if you're buying. And I'm going to fly through this next one, but I just wanted to put this up so you guys can see. A lot of people, what they do is they follow the Fed fund rate, which is completely fine. But I thought this was a really interesting chart because as you watch the Fed funds rate go down, look at the 10-year Treasury next to it. The 10-year Treasury is what we're buying apartment buildings on. And that's a very different. Two more slides is this one. These are properties transacted at the bottom. You can kind of see the multifamily, industrial, office, retail, hospitality. You can kind of walk through there and you can kind of see what's trading and what and when. And you can see where it peaked and where it's headed and where it is. Office is definitely in the worst scenario possible. Again, office is at a little bit different time. I wish you guys the best. I think it's a great time to buy. Thank you very much.